Should you buy a home in today's market? A candid look at U.S. real estate. For many people, the dream of owning a home comes with an unexpected twist. After signing the papers and holding the keys, countless homeowners admit the same thing. It's not as joyful as I thought it would be. When you rent, life feels simpler. Something breaks? Call the landlord, and maintenance takes care of it, usually at no cost to you. But once you own a property, every repair, big or small, comes straight out of your pocket. A burnt-out light fixture, a leaky pipe, or a broken HVAC system can quickly turn into thousands of dollars in unexpected expenses. And those aren't the only costs. Property taxes, homeowners insurance, and in many communities, HOA fees add up year after year. Unlike a fixed mortgage, these expenses rarely stay the same, and they almost never go down. Instead of feeling liberated, many new homeowners feel financially stretched, tied down by obligations they hadn't fully anticipated. This isn't just personal frustration. It reflects a broader truth about the American housing market today. Buying a home is no longer the guaranteed path to stability and wealth it once seemed. Prices remain high in many regions, interest rates fluctuate, and affordability is at its lowest point in decades. For first-time buyers, the gap between aspiration and reality feels wider than ever. So, is homeownership still worth it? Or is renting, once considered throwing money away, actually the smarter choice in today's market? In this exploration, we'll take a closer look at the hidden costs, shifting dynamics, and emotional realities of buying a house in the United States. By understanding the full picture, you'll be better prepared to decide whether now is truly the right time to take the leap into homeownership. Reality from market data. When people talk about homeownership in America today, the conversation often centers around emotions, security, pride, stability. But the hard truth is that the numbers themselves tell a more sobering story. Let's break down what the data actually shows about the U.S. housing market right now, and, more importantly, what it means for you as a potential buyer. Home prices remain historically high. According to the FHFA House Price Index, home values across the United States have increased almost uninterrupted for the past decade, averaging 5 to 7% growth annually. What that means in practice is that the typical home is now priced around $400,000 to $500,000, based on National Association of Realtors (NAR) data. For many middle-class families, that's a number that feels out of reach, especially considering stagnant wage growth over the same period. Even if prices aren't rising as rapidly as they were in 2021, they remain elevated compared to historical norms. Simply put, housing affordability is at one of its lowest points in decades. Mortgage rates, higher than the good old days. If you're thinking, at least I can finance at a lower rate, here's the reality check. Mortgage rates in 2025 are hovering between 6 to 7%, according to Redfin's data center. While this is a slight improvement compared to the spikes of 2023, it is still double the ultra-low rates of 2.5 to 3% seen during 2020 to 2021. The difference is dramatic. On a $450,000 home, the monthly payment at 6.5% interest is roughly $2,850, excluding taxes and insurance, compared to just $1,900 if you had bought during the pandemic-era lows. That $900 plus gap every month adds up to more than $10,000 per year, essentially the price of a family vacation or a new car redirected straight into your mortgage lender's pocket. Living costs continue to climb. Owning a home is not just about the purchase price and a mortgage. Hidden and ongoing costs are rising too. Homeowners insurance premiums have increased 20 to 30% in many states within just the past 2 years, according to Zillow research. In states hit hard by natural disasters, such as Florida or California, some insurers are pulling out altogether, leaving homeowners scrambling for coverage at sky-high prices. Property taxes also tell a grim story. In several metro areas, tax bills have tripled over the last decade, as municipalities struggle to cover infrastructure and service costs. This means that even if your mortgage payment is fixed, your total monthly housing expense is almost guaranteed to rise. For buyers who stretch their budget to the limit just to get in the door, these variable costs can be the breaking point. Liquidity is drying up. Another trend worth noting is liquidity, or rather, the lack of it. Redfin data shows that homes are staying on the market longer in 2025 compared to the red-hot conditions of 2021 to 2022. Sellers are increasingly forced to cut prices or offer concessions to attract buyers. For you as a buyer, this creates opportunities for negotiation, but it also signals a slowdown. If you purchase today and need to sell quickly, you may not get the same bidding war-driven appreciation your neighbor enjoyed just a few years ago. The market is no longer one where any house sells at any price. Timing and patience matter. What does this mean for you? So how do these data points translate into real-life impact? The takeaway is clear. Buying a home in today's market is not just an investment. It's a heavy financial commitment with multiple layers of risk. Beyond the down payment, you should realistically budget an extra $20,000 to $30,000 in emergency reserves for unexpected costs. Roof leaks, appliance failures, rising insurance premiums, or sudden tax hikes. Without this cushion, your financial plan can unravel quickly, turning what was supposed to be a dream purchase into a stressful liability. This doesn't mean buying is the wrong move for everyone. If you have stable income, a long-term horizon, and the liquidity to weather unexpected costs, homeownership can still be a valuable hedge against inflation and a way to build equity over time. But for many Americans, especially first-time buyers, the numbers suggest caution. Renting may not feel glamorous, but in 2025 it can be the smarter, safer financial strategy while waiting for conditions to stabilize. In short, today's housing market rewards preparation, discipline, and a long-term mindset. Enter without these, and the American dream of homeownership may quickly turn into a financial nightmare. Renting versus buying in 2025. Which path makes sense? When it comes to housing, Americans have always been told that buying is better than renting. Ownership equals stability, pride, and long-term wealth, or so the story goes. But in 2025, that narrative deserves a second look. The realities of today's market mean that renting, once dismissed as throwing money away, may actually make more sense for many households. Let's unpack the trade-offs. The case for renting. Renting offers something that's often undervalued: flexibility. Lease terms usually last 12 months, giving you the option to move for a new job, family needs, or simply a change of scenery without the headache of selling a home. In a market where homes are sitting longer and appreciation is slowing, that flexibility is worth real money. Renting also insulates you from unpredictable costs. When the roof leaks, the water heater fails, or the foundation cracks, the landlord is responsible, not you. This protection is especially valuable in an era of rising insurance premiums, costly materials, and labor shortages driving up repair costs. What you see in your lease agreement is often what you pay, with far fewer surprises compared to the unpredictable expenses of ownership. In many cities, renting is also cheaper month to month than buying. According to Redfin, in 2025, the average monthly mortgage payment on a median-priced home is around $2,850 at current interest rates, excluding taxes and insurance. By contrast, the median rent for a comparable property is about $2,000 to $2,200. That $600 to $800 monthly difference adds up quickly. Money that could be invested elsewhere, whether in retirement accounts, stocks, or simply building a healthy savings cushion. The case for buying. Still, buying has undeniable advantages. The most obvious is equity. Every mortgage payment you make chips away at your loan balance and builds ownership in a real asset. Over time, this can be a powerful wealth-building tool, especially if home prices continue to appreciate, even modestly. Renting, in contrast, builds wealth only for the landlord. Owning also offers stability. Your landlord can't suddenly decide to sell the property or raise your rent by 15%. With a fixed-rate mortgage, your principal and interest payments remain constant for 30 years, giving you predictability in an otherwise uncertain economic landscape. That stability can be especially important for families with children who don't want to uproot every couple of years. There's also the intangible factor of pride and control. As a homeowner, You can remodel, paint, and improve your home as you wish. Your space is truly yours, not subject to someone else's rules. For many, that emotional value outweighs purely financial considerations. The 2025 twist, the cost of commitment. But here's where the 2025 market complicates things. The higher costs of borrowing, insurance, and taxes mean that the financial benefits of ownership are slower to materialize. In some metro areas, it could take 7 to 10 years before buying pays off compared to renting once you factor in transaction costs, interest, and upkeep. For buyers who may need to move within 5 years, the math simply doesn't add up. Renting, on the other hand, doesn't just save money today, it also reduces financial risk. You don't have to worry about your home's value dropping or whether you'll be able to sell in a slower market. For younger professionals, singles, or anyone uncertain about their long-term plans, renting is often the more rational choice. So, which is better in 2025? The truth is that there's no universal answer. It depends on your personal situation. If you're financially stable, planning to stay put for a decade or more, and ready to handle unexpected expenses, buying still makes sense. You lock in housing costs, build equity, and gain the pride of ownership. But if your finances are tight, your career is mobile, or you simply don't want to carry the burden of repairs and taxes, renting is not only acceptable, it's often the smarter play. In today's climate, waiting it out, while renting can give you the financial breathing room to buy later on stronger terms. Bottom line, in 2025, the old wisdom that renting is wasted money no longer holds true. Renting buys you time, flexibility, and freedom for financial shocks. Buying can still be rewarding, but only if you enter with eyes wide open and a realistic plan for the long haul. The key is not to follow outdated advice, but to align your housing choice with your financial reality and life goals. For many Americans, the real win isn't rushing into homeownership. It's making the choice that keeps them secure, stable, and prepared for the future. Practical strategies for homebuyers in 2025. If the data suggests that buying a home in 2025 is challenging, does that mean you should abandon the dream altogether? Not necessarily. But it does mean you need to approach the market with a sharper strategy and stronger financial preparation than buyers did a few years ago. Here are some practical steps to help you navigate today's environment. 1. Strengthen your financial foundation. The first step is building a solid safety net. In addition to your down payment, set aside $20,000 to $30,000 in reserve for emergencies and unexpected costs. This cushion will protect you from financial stress when the inevitable happens, whether it's a roof repair, rising insurance premiums, or a sudden property tax increase. At the same time, work on improving your credit score. Even a small bump from 690 to 740 could save you tens of thousands of dollars over the life of a mortgage by lowering your interest rate. Lenders are scrutinizing borrowers more closely, and a stronger profile gives you leverage. 2. Get pre-approved, not just pre-qualified. In today's slower but still competitive market, sellers want certainty. A pre-approval letter from a reputable lender shows that you're a serious buyer with financing ready to go. Pre-qualification, by contrast, is a softer check and carries less weight. Taking the extra step positions you as more credible, especially if you're competing against multiple offers. 3. Consider alternative paths to ownership. Traditional single-family homes may feel unattainable, but other options exist. Townhouses, condos, or multifamily properties often carry lower price tags. In fact, purchasing a duplex or triplex and living in one unit while renting out the others, known as house hacking, can offset mortgage costs and turn your home into an income-generating asset. Shared ownership models are also gaining traction. Some buyers are teaming up with friends or family to co-purchase property, splitting both the risk and the rewards. While this requires clear legal agreements, it can be a creative way to enter the market without carrying the burden alone. 4. Focus on long-term value, not short-term hype. Avoid chasing hot markets just because everyone else is. Instead, look for areas with solid fundamentals: job growth, infrastructure development, good schools, and population inflows. Even if appreciation is slower in the short term, These factors support long-term stability. Zillow and Redfin data tools can help you spot neighborhoods where prices are more reasonable compared to income levels. Don't be afraid to look just outside major metros. Commuter towns often provide better value without sacrificing too much convenience. 5. Negotiate like it's 2025, not 2021. The days of buyers waiving inspections and bidding far over asking price are fading. In 2025, you have more room to negotiate. Sellers are more willing to cover closing costs, make repairs, or offer concessions to close a deal. Use this to your advantage, but only after doing your homework. A thorough inspection report can uncover issues that strengthen your bargaining position. 6. Lock in predictability where you can. While you can't control rising property taxes or insurance, you can lock in stability with a fixed-rate mortgage. Adjustable-rate loans may look attractive at first, but in a volatile interest rate environment, they carry significant risk. A fixed rate gives you peace of mind and predictable payments, which is crucial when other housing costs remain unpredictable. 7. Don't rush. Patience is a strategy. Finally, remember that timing matters. If the numbers don't work for you today, it's okay to wait. Renting for another year while building savings, improving your credit, or watching how interest rates evolve is not wasted time. On the contrary, it puts you in a stronger position to buy when the conditions are more favorable. Bottom line, buying a home in 2025 requires a shift in mindset. It's no longer about jumping in before prices climb higher. It's about preparing carefully, choosing strategically, and thinking long-term. The market has changed, but the dream of ownership is still achievable for those who approach it with discipline, creativity, and resilience. Looking ahead, what the future holds for homebuyers. After examining today's challenges and strategies, the natural question is, what comes next? Should you hold off in hopes of better conditions? Or is waiting just as risky as buying now? The truth is that the U.S. housing market is entering a transitional period. While no one can predict the future with absolute certainty, the data and trends give us some valuable clues about where things may be heading in the years ahead. 1. Home prices, slower growth but still upward. The explosive price increases of 2020 to 2022 are behind us, but that doesn't mean homes will suddenly become cheap. Most economists expect slower, steadier growth, around 2 to 4% annually, through the second half of this decade. The fundamentals remain strong. Demand for housing continues to outpace supply, and construction of new homes is still lagging, especially in affordable segments. This means buyers hoping for a major price crash may be disappointed. More likely, the market will cool but not collapse. 2. Mortgage rates, uncertainty ahead. Interest rates remain the wild card. The Federal Reserve has hinted at gradual rate cuts as inflation eases, which could bring mortgage rates down slightly from the current 6 to 7% range. However, it's unrealistic to expect a return to the ultra-low 3% rates of 2020 to 2021 anytime soon. For planning purposes, buyers should prepare for a new normal of 5 to 6% rates over the next few years. That still represents a substantial cost compared to the past decade, but it's manageable with proper budgeting and stable income. 3. Insurance and taxes, the silent drivers. One area where buyers should stay alert is the hidden cost of ownership, insurance and property taxes. With climate risks intensifying and municipalities facing budget shortfalls, these costs are expected to rise steadily through 2030. States like Florida, California, and Texas could see particularly steep increases. For future homeowners, this means building larger reserves and factoring these costs into long-term affordability, not just a mortgage. 4. Shifts in living preferences. Another trend shaping the future is changing lifestyle demands. Remote and hybrid work remain strong, making suburban and even rural areas more attractive. Families are prioritizing space, affordability, and quality of life over proximity to city centers. This shift could stabilize prices in smaller markets, while keeping demand intense in metro suburbs with good infrastructure. For buyers, it's worth expanding the search radius. Sometimes 20 extra minutes of commuting translates into tens of thousands of dollars saved. 5. Opportunities in a balanced market. The frenzy of bidding wars is cooling, and this is good news for disciplined buyers. A more balanced market means time to think, negotiate, and inspect thoroughly, luxuries buyers didn't have in 2021. It also opens doors to creative strategies like house hacking, co-buying, or leveraging first-time buyer programs that states and local governments continue to expand. Federal initiatives may also emerge to support affordability, especially as housing becomes a top political issue in the coming elections. 6. The emotional reality. Beyond numbers, it's important to recognize the emotional side of homeownership. Owning a home is still a milestone for many Americans, a symbol of stability and personal achievement. But in 2025 and beyond, it should not come at the cost of financial well-being. The smartest buyers will separate cultural pressure, you should own by 30, from personal readiness. Success in this market means making choices that align with your income, lifestyle, and long-term goals, not someone else's timeline. Bottom line, preparing for the future. Looking toward 2026 to 2030, the market is unlikely to offer easy wins. Prices may rise more slowly, but affordability challenges remain. Mortgage rates may settle lower, but not dramatically. Insurance and taxes will climb. Yet within these headwinds, opportunities exist for buyers who are patient, financially disciplined, and willing to think creatively about ownership. If you choose to wait, use the time wisely, build savings, strengthen your credit, and explore different markets. If you choose to buy now, focus on stability, secure a fixed-rate mortgage, budget for hidden costs, and commit for the long haul. Ultimately, the question isn't simply should I buy a house, but am I ready for the responsibility that comes with it? The American housing market will continue to evolve, but the principles of smart decision-making remain timeless. Prepare, plan, and choose what keeps you financially secure and personally fulfilled. Conclusion: expert advice. When it comes to buying a home in the United States, timing and preparation matter more than anything else. From a professional perspective, there are several red flags that should give you pause before making one of the largest financial commitments of your life. First, if you do not yet have a sufficient emergency reserve, typically $20,000 to $30,000 or more, it may be unwise to proceed. Homeownership comes with hidden costs: repairs, property taxes, insurance, and unexpected maintenance. Without a cushion, even a small setback can quickly spiral into financial stress. Second, if you're uncertain about living in a specific area for at least 5 to 7 years, renting may be the smarter option. Real estate is not a short-term investment. It requires stability and time to offset transaction costs and market fluctuations. Constant relocation, or selling within just a few years, often results in losses rather than gains. Third, if you view a home solely as an investment vehicle, remember that the market today is not the same as during the boom years of 2010 to 2020. According to data from NAR and FHFA, housing appreciation has slowed significantly, and the assumption of easy profits is no longer valid. Homeownership remains a powerful and meaningful goal for many Americans, but it is not suitable for everyone, nor is every moment the right time to buy. Renting is not throwing money away. Instead, it can be a deliberate and intelligent strategy to preserve financial flexibility, mobility, and security. The true value of owning a home lies in stability, community, and personal fulfillment, not in chasing guaranteed returns. With careful planning, patience, and honest self-assessment, you can make a housing decision that aligns with both your life and your long-term financial health.